Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Week Wednesday on Dalal Street, Nifty and Sensex slipping a quarter each. Mid-caps taking a bigger hit. The cabinet allows 100% FDI and single brand retail through the automatic route. Stocks like Monte Carlo, Indian Terrain and Canterbury Retail spike in trade today. 5 strategic investors are likely to submit final resolution plans for debt-ridden Bhushan Steel. Religare's executive chairman and independent director quit barely 2 months into the job as its lending arm faces RBI scrutiny. Maharashtra government will allow taller buildings if developers pay a premium. Proceeds to be used to fund Dharavi redevelopment and the Bandra-Versova sea link. We'll get to all of that in a moment, but first the markets. And it's been a weak Wednesday, as we're calling it. Neeraj is here to take a closer look at what's been, or rather, was this in the offing?
Yeah, what's in the offing? Well, 2 days now on a trot wherein we've had a quiet session with mid-caps underperforming, or rather outperforming on the downside as the case may be, but no alarm bells as yet. The Nifty Bank 2 in today's session, incidentally, is down about 0.5% or thereabouts. So it is underperforming and underperforming quite a bit in the session today. I thought HPCL's chart was very interesting. If you just look at the intraday of Hindustan Petroleum, it started off fairly weak and then ending up close at the day's highs, so to say. So good performance by HPCL. It's a quiet IT pack, so ahead of earnings tomorrow. And despite Infosys coming with a very good piece of news, so to say, it's not really a blockbuster move, just the late minute surge for TCS, but all the other stocks are lying very, very quiet. At the broader end of the spectrum, individual performers, as would be the case in retail, for example, Canterbury Retail, V-Mart and a few others, some which are impacted, some which are not, some which want funds, some even though they are single brand retail companies don't even want that fund infusion, but all of them are active in the session today. So that pocket is a buzz. And I think the oil spike is leading to gains in stocks like Alpha Geo, Aban Offshore and some of the crude explorers, offshore drillers, etc. So the Aban Offshore and a couple of other stocks seem to be doing okay in the session today, led predominantly by this uptick in crude prices. So 14% for Aban, 15 million shares traded, by the way, there. Dolphin Offshore up about 9% as well. The clutch of these names seem to be doing okay in the session. Harsha.
Neeraj, thank you for that. We're at the cusp of another earnings season. IndusInd Bank, TCS, Infosys, as always, will kick off results this week. But before we get caught up in the frenzy of all of it, Darshan is standing by to give us a sense of key trends that define the third quarter. What are analysts pricing in from different sectors and different companies? Darshan, so what can we expect?
So earnings season kickstarts tomorrow. The big earnings tomorrow will be IndusInd Bank, which will come out during market hours, TCS after market hours, and on Friday after market hours, we will have Infosys. So that's the big trend that we're getting, and a couple of mid caps will also come out. There'll be Syntex, there'll be Shree Cement. But what has been the trend so far? So what we're seeing is that the number of strong results over the past 3 quarters has come down drastically. From 23, it's moved down to 13, and at 16, even the weak numbers have moved down. What has happened is that the trend of meeting or coming out with numbers which meet estimates has gone up from 15 to 18 in the first quarter to 24 in the last quarter. So last quarter was a quarter wherein so it's changed from a strong quarter to a weak quarter to an inline quarter in the past 3 quarters. So this time, let's see what exactly happens. Now, what are the key factors and trends that we are tracking this time around? But firstly, what are the earnings estimates? Edelweiss, Kotak and Motilal Oswal believe on the top line it will be 16 to 20% for the Nifty and 12 to 18% on the bottom line for the Nifty 50 companies. Now, the key trends that we need to watch out for: consumer facing and auto companies will actually have significant amount of volume growth with margin improvement. It comes on the low base of demonetization quarter. Similar is the case with retail, media, consumer durables, all of them. PSU banks will be hit by lower treasury income because of higher bond yields this time around. The other sectors that we need to watch out: pharma, earnings pressure will clearly be seen, competition will clearly be seen. As far as upstream oil companies concerned, they will be in benefit because of rising crude prices. And technology, it will again be a muted quarter this time around. So that's the general trend that we're getting in some of the factors that and key trends that will be likely. Individually, Maruti, market share gains will be clearly prominent in Maruti because of the auto sales numbers that we've seen. Tata Motors can be the joker in the pack. Improved Jaguar performance and the product mix is something that is extremely positive. You have Ashok Leyland concerned, BS4 norms will impact them definitely on the positive side. There will be improved product mix in Bajaj Auto, but the big concern will come in Eicher because volumes have been rather stagnant. The other sectors that you need to watch out for after auto will be the financial. PSU banks may continue to lag private sector banks, and they will hit on account of treasury yields falling down, so that will be impacting them. Asset quality definitely eyed in ICICI Bank, Yes Bank and ICICI Bank, and NBFCs are expected to sustain growth momentum going ahead. As far as the cement is concerned, you have counters like ACC and Shree Cement which will benefit from East India exposure, while sand shortages will impact companies in South India. The next sector is FMCG. They will all come in from a low base of demonetization last time around. GST impact will be seen on ITC on the negative side and positive for HUL on the positive side. Alcohol companies will be clearly watched out after strong numbers from GM breweries. The next one is IT. Mid caps are expected to outperform the large caps. IT and Infosys, we are seeing TCS and Infosys 1 to 1.5% constant currency growth. It will be much more as the rung goes down even lower. The next sector that we'll talk about will pretty much be the pharma sector. Cipla, Sun and Cadila will report strong numbers. They've come in from a low base, but the pricing issues will impact Lupin and Dr. Reddy's going ahead. The next one will be telecom. Cut in IUC cuts will expected to have big impact on the numbers, and Reliance Financials will be the most watched out on the Jio front. On the oil and gas front, upstream will benefit of price hike, and Reliance will benefit from the ramp up in the new capacity. And you have the metal space which is there. Both of them, ferrous or non-ferrous, both of them are expected to have a very, very strong quarter this time around.
Darshan, thank you for that. But the news flashing across your screen, three more developments as far as the foreign direct investment policy of India is concerned. There have been an amendment. One is 100% foreign direct investment allowed in the construction sector. That's going to be significant for construction companies. FDI up to 49% has been allowed. Foreign airlines can invest up to 49% in Air India. Decks have been cleared in the overall cleanup act of Air India. So you're seeing 49%, up to 49% can be invested into Air India by foreign airlines. Another slightly minor one is how foreign institutional investors or FIIs can now invest in power exchanges through the primary market. Three significant developments as far as foreign investment rules are concerned. One in the construction sector, the other in aviation, particularly with respect to Air India, and the third one, of course, 100% foreign direct investment in single brand retail that's been completely allowed. That is through the automatic route. There has been no approval process that's going to be required. Specifically on construction and on Air India, we'll come back to you with a little more details. But oh, there I have it. As I'm looking at the Bloomberg terminal, the Indian Energy Exchange has risen about 3.5% after the FI investments have been allowed in that space. But we'll focus on what debt-ridden steel companies are doing. They're attracting a lot of interest, not just from domestic players. The latest example is Bhushan Steel and Electro Steel. Sources tell Bloomberg Quint's Vishwanath Nair that strategic investors have submitted the resolution plans for both these steel makers. Vishwanath is standing by to tell us who they are and what the interest is about. Vishwanath.
So, from what we understand from our sources, especially in Bhushan Steel, there are about 5 companies. There's Tata Steel, Vedanta, there's SAIL, and a couple of others who are already working on or are in the final stages of coming up with a resolution plan. Now, January 18th, that is what the resolution professional has set as the final date for submitting the bids, which they will be doing as the days come. Apart from that, Electro Steel, they put out a notification on the stock exchanges yesterday where they said that 4 players, which was Tata Steel, there was Vedanta, there was a fund which was backed by Edelweiss ARC, and Renaissance Steel, which is a Dalmia group, somebody from the Dalmia family who promotes it. All of these 4 people have already submitted the bids. See, what is interesting to understand here, Harsha, is that Bhushan Steel is 55,000 crore debt, right? With Electro Steel, it's about 13,000 odd crore. It's these are massively debt-ridden companies, and as and when you see interest coming in from domestic as well as foreign investors trying to buy these companies, it makes a lot more sense for the bankers, because it gives them a good price discovery. It gives them the ability to understand what is the kind of haircut they will be taking. We don't know what these bids are like, what the price is like, but as the days go, we will get to know more information, and therefore that will sort of set the trend of what is going to happen with more stressed companies in the future.
Vishwanath, thank you so much for that. That's what's happening in the steel space with Electro Steel and Bhushan Steel as well. But I'm just going to shift focus back to what's happening on the foreign direct investment front. There's one more minor tweaking of definition, amending of definition as far as FDI and medical devices is concerned. That's been approved by the government of India. Cabinet has also, as I mentioned earlier, 100% automatic route for construction, for single brand retail, and FI have been allowed to invest in power exchanges, particularly through the primary market route. So these are important foreign investment rules that have been changed, that have been approved by the cabinet. 100% through the automatic route for single brand retail, and you're seeing the market react. More details in a moment, but let's move on now and tell you about Eon Capital's JSW Steel consortium is set to be the only bidder for Monet Ispat. While lenders have deliberated over the 7,500 crore write-down that's said to have been proposed by the bidders, Yatin's done some calculation to figure out what's in store for existing shareholders if this deal were to go through. Yatin.
Thanks for that, Harsha. Of course, as you were mentioning, 7,500 crore or 75% write-down is what the lenders are looking at. Probably, the minority shareholders also are most likely, to get impacted because of the transaction. We have done a scenario analysis in which we have done a lot of assumptions. Number one is haircut, which we have assumed will be 75%, which means that the debt will be cut down to a level of 2,500 crores, and this is as per the news reports and the probable resolution plan that JSW's consortium has submitted. Also, there will be a fresh equity issue of 1,000 crores. So the bidder gets in close to 1,000 crore capital in order to restart operations, probably put in some working capital, and that is most likely to be at par or a face value of 10 rupees each. Now, let's assume, the total capacity of close to 1.5 million tons, and let's value the entire capacity at $465 a ton, which is basically a brownfield expansion cost that JSW is already undertaking as per the CLSA report, which means that the total enterprise value for a company like Monet Ispat will be close to 4,550 crores. Subtract the debt portion, which we assume to be close to 2,500 crores, and the derived equity valuation would be close to 2,050 crores. Coming to the next slide, which indicates as to how the metric is changing. Currently, for the simplicity of calculation, we have assumed the total number of shares at close to 20 crores, which is close to 20.7 crores currently. The new share capital which will be infused will be close to 100 crore shares, which means that the total number of outstanding shares for Monet Ispat post the resolution plan could be as high as 120 crore shares. And if you divide it by the equity value which we got from last slide, which is 2,050 crores, each share valuation works out to be 17 rupees, which is half of what the current market price of Monet Ispat is. But of course, market has its own style of valuing companies, and what the market is currently looking at, which will be there in the next slide, which is on the basis of the assumption that a 1.5 million ton plant can do a EBITDA of close to 1,000 crores, give it a EV EBITDA valuation of 7 times, and you will get an EV of 7,000 crores, which again translates into equity value per share of close to 37 rupees, which is again close to the current market price. But clearly, what we are trying to portray here is that the market assumes a valuation, the lenders and the resolution plan seeker has a separate valuation metric. But minority shareholders must understand that there will be no open offer as far as the transaction is concerned, and more importantly, the kind of equity dilution one could see could be very large. Probably the current shareholders will have to take a very big hit if the equity dilution were to happen at a much substantial lower valuation than what we have assumed.
Yathin, thank you for that. Let's move on now to the latest on the JP Home Buyers case. The Reserve Bank of India has sought Supreme Court's permission to file insolvency case against JP Associates. The Apex Court will consider the request as a later stage. Arpan joins us from Delhi with the details. Arpan, what's the issue at hand? What's the development?
Yes, very much. So now, why the Supreme Court's permission, or the reason why the RBI approached the Supreme Court was that the home buyers case, as I think, was related to JP Infrastructure Limited. And in that, the Supreme Court had also asked the JP Associates to deposit 2,000 crores to protect the interests of the home buyer. And now, when the RBI wants to initiate the insolvency proceedings, there has to be modalities worked out as to what will happen to the direction of the Supreme Court, where they have asked to deposit that amount. So in response to that, the RBI has come to the Supreme Court and asked Chief Justice of India as a bench that for the least approach to incentive, the Supreme Court has not given a definitive answer either way. For now, what they have said is that they have asked JP Associates Limited to give the details of how many housing projects they have and what is the stage of construction, and the court making it very clear that all they are concerned with is that the home buyers either get their money or their flat cash. So that is why the court has sought the details of the housing projects of and JP Associates Limited, and has said that as far as the permission or denial of permission to go ahead with the insolvency proceedings, that will be dealt at a later stage.
Arpan, thank you for that. Well, let's move on. There's another round of top management exodus at Religare Enterprises. Bloomberg Quint learns that the executive chairman and independent director have stepped down. Riddhima Saxena is standing by with some details. Riddhima, who has stepped down and do we know why?
Yes, Harsha, it seems to be the impact of RBI's second letter that inquiring into the corporate loan book of its lending arm Religare Finvest, that resignations have started coming through. The barely 2 months into their jobs, Executive Chairman S. Lakshmi Narayanan and Independent Director Kishori Udeshi have put in their papers. Now, their resignations are yet to be announced in the exchanges, as both of them still await RBI's approval. To give you a little bit of the background, an earlier round of resignations had also come through when RBI had sent its first letter in January, and after that, in September, the Chief Executive Officer and whole-time Director Sunil Godwani had resigned, and very soon after that, in November, the CFO and 2 independent directors as well as the company secretary had also put in their papers. So it seems like that a lot of management has been resigning as a response to the RBI's inquiry into Religare Finvest.
Can you elaborate what that scrutiny is? Why is Religare facing scrutiny by the Reserve Bank of India?
Correct. So, Religare has been facing RBI's scrutiny for some time now, and in January it received the first letter, as I had mentioned. So in the July report of the auditing firm PricewaterhouseCoopers, which is also the auditing firm for Religare Enterprises, it noted that RBI had in fact sent in these letters, and there was scrutiny on Religare Enterprises or lending arm Religare Finvest corporate loan book as well as the credit worthiness of its borrowers. In fact, the PwC report also stated that RBI had cited accounts of borrowers that were found to be routing money into group entities. Now, this case is basically about the corporate loan book that has that currently stands at 2,272 crore rupees, and it has increased as CARE rating suggests, because the commercial paper of some of the stressed group entities were converted into loans. Now, the second letter of RBI has asked the company to respond definitively today, which is January 10th, and has also restricted it from not using any of the proceeds from the stake sale of either Religare Health Insurance or Religare Securities without prior RBI's approval. RBI has also asked Religare Enterprises management to give the details of the foreign investor that is looking out to buy the NBFC arm, and also give a month-wise plan of how they plan to liquidate the corporate loan book.
Riddhima, thank you for that. That's what's happening in Religare. Let's move on now. AirAsia India may not be far away from a potential IPO. At least that's the word coming in from CEO Tony Fernandes in a Twitter post earlier today. He said the airline will seek board approval to pick a banker next meeting. Anurag Kotaki of Bloomberg News joins us with more details on this one. Anurag.
AirAsia's group CEO Tony Fernandes said AirAsia India is not far away from an IPO. At the next board meeting of AirAsia India, the parent company will seek approval to appoint a banker to kickstart the process. Fernandez said while analysts are giving zero value to the airline, he sees huge growth potential in this company. While we don't have much details available at this moment, airlines in India have had a really good run of late. India is the fastest growing aviation market in the world, and an emerging middle class flying for the first time. The potential is huge. India is already the third largest domestic aviation market in the world and is said to be the third largest even internationally by 2036. Particularly after the oil crash in 2014, airlines in India have had a very good run, as almost 50% of their cost is for fuel. Indigo is up almost 50% in the past 12 months. Jet Airways and SpiceJet are both up more than 100% in the same period. So the time is lucrative to do an airline IPO in India. Having said that, AirAsia India has never made money in the 3.5 years of its operations in the country. And in fact, it lost more than 150 million rupees in the 3 months that ended in September. So we'll have to wait and see how this goes and whether investors are willing to lap up shares of an airline that doesn't make money.
Anurag, thank you so much for that. That's AirAsia for you. Cement makers, meanwhile, have taken a price hike in January, with players in west and southern regions undertaking steeper hike. Nikki is standing by with some more details on what led to this price hike and how much was the quantum of that. Nikki.
It's a seasonally strong period for the cement companies starting January. So most of the cement players have taken a price hike, but then the price hike, this is the second consecutive month that we're seeing that the prices have gone up. If you look at the price hike, the depressed region, that is the south and the western region, they have taken a steep hike, just you mentioned. Also northern region, that's something which is interesting, that prices in that region particularly has come down in the month of Jan and has been pretty much stable or flat in central and eastern region. The hikes have been undertaken after a muted Q3. If you look at the bar chart here for northern players, you would see that northern players back in December 2017 had actually increased their prices sharply by 16 rupees per bag month on month, and now they've reduced it to 12 rupees per bag in the month of Jan. This is after the relaxation of petcoke orders by Supreme Court, which has made them roll back the price hike that's seen in the month of December. Southern region, now that's comparatively a weaker region. It's for the second consecutive month that we're seeing the price hike coming in for this region. It's particularly in the state of Kerala, Telangana, Tamil Nadu and Andhra Pradesh that the prices have been hiked on month basis in the range of 23 to 25 per bag. The prices have been falling since March 2017. This is on account of weakness and the in infra demand that we've seen mainly on account of sand shortage. In the western region also similar trend playing out. You would see the prices have increased after 2 consecutive months of declines. The prices have seen a meaningful increase in Maharashtra, which is up 15% per bag on month basis, and had been higher had it not been for the decline that we've seen in Gujarat region. Lastly, if you look at the quarterly chart here, you would see Q3, the prices on all India basis have actually snapped a 5 quarters winning streak that we've seen, or the gaining streak that we've seen in the prices. This is mainly on account of the depressed pricing that we've seen in southern zone.
Nikki, thank you for that. Well, we'll step in a short break on that note. On the other side, we're going to take stock of the rural economy as we head into Budget 2018 with former Planning Commission member Vijay Sen and S. Shivakumar, Agri Division Head at ITC. That discussion coming up on the other side.
Are we live? Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world. Until till now.
More than just business news, we're news for business people.
Back on lunch, the headlines at this hour. Week Wednesday on Dalal Street, Nifty and Sensex slipping 0.25% each. Mid-caps take a bigger hit. Cabinet allows 100% FDI and single brand retail through the automatic route. Stocks like Monte Carlo, Indian Terrain, Cantabile Retail spike in trade today. Foreign airlines can now invest up to 49% in Air India, but under the approval route. 5 strategic investors are likely to submit final resolution plans for Bhushan Steel. The markets, as we said, it's a weak Wednesday. You are seeing some pressure building up, particularly on the benchmark indices and stocks across the board, and even in the mid-cap space. Pradeep is here to take a look at some of those stocks that have been facing the heat. Pradeep.
Yeah, so first of all, to talk about markets, like we were discussing for the last 2 days, it's getting a bit heavy on the higher side, and between 10,650 and 10,700, in fact, call writers for looking to build some short positions or shorting the market. That was the likely strategy, and that is what is playing out. So at higher levels, we are seeing some selling pressure. But yesterday onwards, now if you see, the market breadth has also turned negative, and also VIX, that has been consistently rising, has gone up. So if you look at individual stocks and sectors which have suffered the most, is the banking, first of all, especially the PSU bank. They were already underperforming, and there is still a fear that maybe you won't see a very significant rise in the NPA, but there could be one account here or there that could slip further, that was still in the watch list, or were suspected to become NPA, or were a part of stressed asset, could now turn into NPA. And even if that doesn't happen, the provisioning requirement will continue to be higher. So these stocks still look expensive. People are waiting for some kind of a decisive trigger that would probably re-rate these stocks, and that is not happening. So that is one segment which is definitely looking weak. There is some pressure on select commodity pockets also. And in mid-cap space, in fact, if you look at the names which are down, for example, Phillips Carbon or HEG, these stocks have appreciated quite a bit from lower levels. So Phillips Carbon, for example, within a week, if it goes up by 40%, it can easily correct by 10-odd%. So it corrected yesterday, it's correcting today as well, which is probably kind of overowned by traders in the short term. So there is some kind of selling coming in, or rather profit booking coming in those stocks. But if you speak to traders, their normal strategy right now is to kind of reduce exposure at the higher levels, like I mentioned, between 10,650 and 10,700. They are looking to unwind and then wait for maybe a few days to get in once again at lower levels, because they feel that the target for this month has probably been achieved too fast in the early week, or the first or second week. So there could be some cool off before we go up once again.
Okay, hold the thought, Pradeep. You've also been tracking the oil markets. Oil extended gains from a 3-year high as U.S. industry inventory data signal crude stockpiles drop for an 8th week. What's the market looking like, and where are prices headed?
So basically, if you look at it, it's the inventory data that has spooked the market today. But this is a consistent trend since June. If you see, when oil was around 45, from there we have gone up, gained almost $25, one way. So this chart right now on screen is a monthly Brent crude price chart that will tell you that we have been consistently moving up without any correction. The reason being, better compliance from OPEC. What is also significant before we go to the next chart is that $70 mark is the high that we had seen in 2015. So this is a significant mark technically that traders would be watching out for. There could be some profit booking at this level, and we may, correct from here. Or if we decisively cross 70, then maybe there could be significant upside. But the key driver, as I was talking, is basically the improved compliance that we have seen June onwards. And that is why over the last 6 months or so, we have seen this consistent move up. And in the meantime, and now you can see this chart, which is actually showing you the correlation between crude prices and OPEC's production. So you can clearly see, in periods when production has come down, prices have appreciated, and vice versa. So the huge correction that we had seen, in 13 and 14, especially in 2014, was on the back of rising crude production by OPEC when they were kind of, targeting the shale producers in US, and they thought if they could hold the prices low, then shale will probably turn unviable. Now, after that, initial phase, now for last 6 months, they have been tightening the production, and that is why prices have gone up today. There's an interesting comment, though, from Iranian oil minister that probably this is beneficial to US crude and we need to rethink. But the rethink they will, but that is, as per plan that was discussed in November meeting, the reconsideration happens only in June. So we have 6 months to go. Till then, I think technically traders are looking at 70, but fundamentally going by the way inventories are falling, I think crude could definitely go up.
Pradeep, thank you for that. The Chinese central bank, meanwhile, has tweaked the management of daily currency fixing. The PBOC is now moving towards a more market-determined rate for the yuan. Let's go across to Bloomberg's Tom McKenzie in Beijing to know what's the reason behind this latest step, and more importantly, why now?
The yuan ended the year up about 6.8% versus the greenback. We've also got the fact that the capital controls are still in place here. The economy is ticking over fairly nicely, and those yuan bears have been crushed. So the PBOC feels relatively confident that it can loosen the strings on the straitjacket around the currency, and that's why you've seen this move to suspend this counter-cyclical factor. As you said, one element that is used in terms of determining the fix on a daily basis for the currency. We do have a terminal chart, G #BTV 5135. As you say, it was introduced in May of last year, and as a consequence, you saw some of the volatility ease, and that was a key part of introducing it, was to reduce some of the volatility around the currency, and it strengthened, as you saw, against the US dollar. Then they suspended it just a few days ago, and there you see the dollar ticking up against the renminbi. Now, Nomura have said to us that they do expect to see a bit more volatility around the currency going forward, but it is seen by most economists that the PBOC is relatively relaxed about the trajectory for the yuan going forward. In terms of what it means and whether or not the currency is going to become more market-oriented, potentially this is a baby step in that direction. They're back on track, at least, after the shocks of 2015. They imposed those capital controls. They put this factor in place. Now they're starting to take some moderate steps back. But will they expand the trading ban? That's a potential move that could happen. Capital controls are likely to remain in place this year, according to most economists that we speak to.
Tom McKenzie talking about what the PBOC has done. Well, let's get on a terminal chart of what equity markets worldwide have been doing. They've been on a record, leading to concerns whether valuations have run away way ahead of fundamentals. This is the chart I want to bring up from the Bloomberg terminal. It's a bit confusing, so let me explain. So you have the lines are about 5 equity market indices. The green line is the MSCI Emerging Market Index. The blue line is the Asia Pacific Index. The purple line is the MSCI World Index. The white line is S&P 500, and the copper sulfate blue color, the light blue line, is the Nikkei 225 index. Now, what this line and the red line that you're seeing across is the overbought zone. That's 70 on the relative strength index, which is essentially a magnitude of price fluctuations, and tells you if anything is in the overbought territory, which means you are in a peculiar situation where most of these indices are trading above the 70 line, which means they're all in the overbought zone, giving a fairly significant sell signal. Call it equities euphoria, call it the Trump tax rally, call it melt up, but this is how equities are positioned across the world. Last point, there's been an investor survey done by the American Association of Individual Investors, and nearly 60% of them believe that the US markets are headed even higher from these levels. That's the highest percentage that's been recorded since 2010, indicating the kind of underlying bullishness that remains in the market despite these valuations. Okay, back home. We were talking about the foreign direct investment rules, 100% invest through the automatic route in retail. In the aviation sector, foreign airlines can now invest up to 49%, of course, through approvals, while the control will remain with Indian nationals. What does this mean for Air India? Former Aviation Secretary K.N. Shrivastava now joins us on the phone line. Mr. Shrivastava, thank you so much indeed. We have seen the government, in a sense, take a series of measures to clean up Air India. How do you see this move specifically to allow foreign airlines to invest up to 49% in Air India? Do you see that as a step in that direction?
Certainly, it's a step in a positive direction. But then here I would like to say that in the year 2013 itself, the government of India had permitted FDI in the Indian carriers up to 49%. You may recall that at that time, 26% stake was, picked up by Etihad in Jet at that time. So perhaps what has now been done is just a continuation of what was done in 2013 itself. So far, the Air India is concerned, given the kind of debt burden with which it is laden, one really doesn't know as to whether there will be prospective investors interested to pick up 49% stake in Air India in view of the huge debt burden which Air India is having.
Right.
So if investors are interested, certainly it will be a very welcome thing, for the country as a whole.
Sir, two questions. We've also seen the parliamentary panel recommend saying that, look, Air India should not be privatized. You should let it for 5 more years to continue, and then take a call. As someone who's been in the seat before, what's your sense? How can Air India be tackled? Because we've been discussing this whole issue of privatization for a very long time now.
You see, I have been a very strong votary of privatizing Air India since the beginning. No doubt, intermittently, there have been some good, performance records of Air India last year, or even in 2012-13, Air India had made operating profit. But the fact remains that Air India is having a huge debt burden of more than 55,000 crores. So even if there is some incremental, improvement in the operating, performance of the Air India, the overall financial picture of Air India will continue to remain, gloomy. In such a situation, as you are aware, the government of India has been investing almost 5,000 to 6,000 crores into Air India just to keep Air India afloat. Whether, this 5 years leeway or the, extra time which the parliamentary panel has recommended is going to make any headway, because the financial burden of 5,000 to 6,000 crores annually on government of India will continue to remain like that. So I do not think that it will be a prudent measure to allow Air India to continue under the government control. It is better that government should take the bull by its horn and go ahead with the complete privatization of Air India.
One final question, sir. Do you see any bidder or any foreign airline evincing interest at all after this rule today? I
am skeptical. As I mentioned, that as long as the debt burden remains at that level, certainly I'm not seeing very many, investors interested. Rather, hardly anybody interested. So first of all, about the huge debt of Air India has to be tackled by government of India unless the debt burden is reduced. Meaning thereby that part of the debt has to be taken over by government of India. Then only I see, some prospective investors getting interested in it.
Mr. Shrivastava, we'll leave it there. Thank you so much indeed. That's the former aviation secretary saying privatization is perhaps the only way out for Air India. He does not see any foreign investor, foreign airline evincing interest even after the government has tweaked FDI rules to allow a foreign airline to come and invest up to 49% in Air India, although the control will remain with an Indian national. He doesn't see that changing the situation. Let's move on now. Paying with our phones may be easier than ever, but understanding which service to use and when it isn't. Now, Google is streamlining all of these methods and apps into one single service called Google Pay. Nishant Sharma is standing by to tell us why this is important and how this might make your life easier. Nishant.
Rightly said, Harsha. Google is consolidating all its payment options, Android Pay, Google Wallet, and payments on Chrome under one offering called Google Pay. Now, the move is aimed to tackle giants like Apple Pay and Samsung Pay in the Western market. So what's going to happen now is payment information stored on any of your Google accounts can be used to make payments on app, offline. If you want to shop online using the Google platform, anything can be done. Just all the customer has to look for is a Google Pay option, and the payments can be seamlessly made online. What's in it for Indian market? Well, as far as India is concerned, Google has a separate payment platform called Tej, which it launched in the middle of last year. And now it started as a peer-to-peer payment platform, and Google has been ramping up its offering by utility bill payments and tie with other companies as well to facilitate payments as well. So Google said in the blog post that the experiences of the Google Pay platform will soon be brought to the Tej platform as well. And if that happens, Google might just create one of the most holistic digital payments platform for the Indian users.
Nishant, thank you for that. All right, let's move on now. Bajaj Auto wants to rediscover a more prominent position in India's domestic motorcycle market. The company launched 2 motorcycles under the Discover brand to cater to what the company calls the executive segment, which it says accounts for nearly half of the domestic motorcycle market. Alex Matthews spoke to the Bajaj Auto management to find out why they're betting big on Discover once again.
The change in strategy has 2 legs to it. One is a completely revised product, which is the center stage of the strategy. So all new engine, cubic capacities have been redefined to the 110 and the 125 cc cubic capacities, which we believe is the correct cubic capacity for this part of the market and this type of customer. And the second part of the leg is in terms of as you mentioned, we've been very quiet about the Discover. We've been quiet because I think it takes time for us to figure out the right kind of solution for the market. We believe we have the right kind of solution for the market. We've tested it very carefully over the last couple of months. And we believe we have the right solution to the market, which will allow us to invest significantly behind this brand once again.
Is there a worry that customers will sort of get confused about the fact that it wasn't in the market for some time, it's coming back, maybe it's not so different from what it was?
I don't think so, Alex, for 2 reasons. One is we have been selling the Discover 125. We have not invested in marketing, but we have been selling approximately 8,000 numbers every month for the last 2.5 years. So there are customers out there, they have been buying the bike. The bike has never vanished, but it was a single product, very quiet as you mentioned. And now we are back. I think customers will like the product they see and they will buy it.
Now, with regard to the market share that you're hoping to gain, in the presentation that you made earlier, you talked about the executive segment being premium 100 to 125 cc. And you said that it's just a little over 50% of the market.
That's correct.
What are you hoping to gain with the introduction of this or these 2 bikes in the segment, and what do you want to end up with at the end of 2018, say?
Yeah. See, ideally we would target by the end of 2018, this time next year, we should be selling around 70,000 plus bikes in this segment under the Discover brand. That is our target. That would translate to a market share of approximately 15%.
That's Bajaj talking about or rediscovering its Discover platform. As we head into Budget 2018, Bloomberg Quinn caught up with the former Planning Commission member Abhijit Sen and S. Shivakumar, the Agri Division head at ITC, to take stock of the rural economy, its challenges and what needs to be done. Here's a slice of that conversation.
This year is somewhat different from the prior 2 years. You already talked about low prices. I think that is the fundamental reason for pressure in the current year. The prior 2 years were somewhat relatively lower production but better prices. And I think as part of controlling food inflation, whatever got initiated, I think led to some of these lower prices. And because the monsoon was good, crops were better, and there was some excess planting also in crops which saw higher prices in the previous year. So consequently, you had a situation of oversupply, and that led to a drop in prices. And there was not so much of export demand also because rupee appreciated, and in some commodities because of erratic rainfall here and there was some crop quality issues also. So I think the prices remaining low is what the year would be known for more than anything else as far as agriculture is concerned.
Let me put that question to Dr. Sen as well. Dr. Sen, say the last 1 year when we've at least started to hear a lot more about stress in the agriculture sector, are you in agreement with Mr. Sivakumar that the core problem has been price levels?
Yes, the last 1 year certainly has been the price level. Output has rebounded. The previous 2 years were bad on the output side. Prices were okay. But taken together, you've got 3 years, 2 bad on the output side and 1 disastrous on the prices side, while being good on output.
Dr. Sen?
Now 2017-18 is, yeah, go ahead.
Sorry, I didn't mean to interrupt. Please complete your thoughts, sir.
Yeah, 2017-18 has just, harvest has only started coming in October. So I think a lot of that is still up in the air. I believe that the GDP, the GVA figures from agriculture that you referred to for 2017-18 might be somewhat underestimates. They are based on the first advanced estimates. They tend to be lower than what it finally actually is. We certainly know that on certain crops like cotton, it's going to be much better than those estimates say they are. Nonetheless, I think really what the year which has started already, that is the 2017-18 crop, coming in from October, and then the Rabi will come in, April onwards. I think that's the one to really look at, because prices are still fairly low. Area sown figures for Rabi don't look particularly good, except for pulses. And the Kharif figures, although they're likely to be better than what the advanced estimate puts it, are far too low compared to what we know happened in the monsoon. Despite a few aberrations, the monsoon was fairly good. So as far as agricultural production goes, I'm a bit disappointed. Given 2 good monsoons in a row, I would have expected a much better year this year. But the rural situation this year, quite apart from the fact there's not output so much as it is prices, as Shivkumar pointed out, it's also something else. It's construction continues to be down. And that has an immense amount of impact. And that has an impact upon wages, and a lot of agricultural families now get their incomes from other things. Agriculture makes up less than half of rural incomes. And all of that actually adds up to what the rural situation is. And I think there, the construction as well as the MSME sectors are possibly equally important as agriculture, if not more, for things like FMCG demand.
Let me put that question to Mr. Sivakumar. Mr. Sivakumar, is that what you hear from your folks on the ground, that the problem may be coming in from other areas as well? But the rural demand indicators from a corporate perspective have been very confusing. Tractor sales have been, for instance, very, very strong. FMCG numbers were down, but we've seen companies indicate to better times ahead. Can you give us a clearer sense of what's happening in terms of rural demand, which then brings together agriculture and some of these other ancillary activities that the rural sector is dependent on?
Yeah, so while on aggregate there is a pressure, but I think part of this agricultural distress on account of low prices is partly made up by some cash flows out of the government spends. One is of course construction. Although Professor Sen said there is some level of down, I think some states the movement for rural housing on account of government fund flows has been better, which compensated these lower prices in terms of certainly cash flow and some wage labor. We also saw Narega funds being allowed for spending on farm ponds and some agricultural activities in asset building. So that also gave some more wages and cash flows. And loan waivers in a few states brought in some more cash and fresh borrowings from the bank. And of course, the overall credit flow continued to stay up. So I think some of these cash flows, notwithstanding lower prices, if we saw at the end some level of growth being projected, is on account of these things. And obviously, these cash flows also meant keeping up some demand improvement from an FMCG perspective. And the tractors demand is more arising out of previous years' higher prices and the whatever loan waivers happened somewhat an early stage. I think some of that was deployed in tractors, not so much because wages were becoming higher, but I think partly because availability of labor at the peak time for the farmers' requirements. Keeping that in mind, farmers have invested the prior year's higher incomes also into tractors. So I think some of these other elements, if they were also not there, obviously we would have seen a deeper distress. But I think some of that spends from the government have actually made up the situation, and that's how we are receiving some positive signals